Welcome to the Big Skinny with Lou Basenese. We got some fans in the house tonight, or this afternoon. I always get my time mixed up. But hey, I'm Lou Basenese, where we bring you all the financial and investment insights with all filling, no fluff. That's what the Big Skinny's about. You're probably going, where in the heck does this name come from? What does it mean? Well, let me tell you. Especially if you are familiar with Urban Dictionary, it calls the Big Skinny insider information, and we are not that. I do not want to end up in an orange jumpsuit and in jail for providing material, non-public information. But what we are is your source of essential truths when it comes to the markets. Because I'll tell you something, especially on days like today, when the market is crashing, cratering, selling off, and headlines are popping up everywhere, there's $5 trillion in wealth that's been lost. You need to get beneath the headlines. You need to know what it really means and what it really means for your portfolio. So we're going to give you that, the essential truths. And we do that in a very straightforward, consistent format. If you've been reading our newsletter, I do it in one headline that you should ignore or think twice about, one chart that is going to reveal the data that provides the key insight, and then we end with the insight. What does it mean for my investments? So we cover that in the top of the show every time with 2 to 3 topics that are quintessential and essential for you to understand in this given week in the trading market. Then we flip to a market guest, a friend, a fellow pro, to add insights where I can't sometimes. I'm the first to admit, be humbled or be humbled in the market. And I know there's a lot of smart guys out there and women that can help us and help every one of us listening do better in the market. So we're gonna do that today. One of my best friends, Keith Fitz-Gerald, worked with for over 20 years, believe it or not. And then we wrap up usually with a new tech trend or company that you should be taking a look at. A lot of times it's a micro cap technology, small cap technology, but given today's sell-off and this week's sell-off, I'm gonna spend some extra time holding some hands, not kissing the babies, but just showing you what matters. Let's address why before we start looking to buy, why we should be comfortable buying in this market. All along the way, you're here joining us on multiple live streams. Please do not be afraid to speak up. Share your comments, criticisms, and burning questions with, hey, give me a stock ticker even. If I don't know it, I'll look it up. We'll try and figure it out on the fly. But we want this to be interactive and on the run. So that's what we're going to do here. So please do not be shy to speak up. So with that being said, let's go ahead and get to our rundown of the 3 most important news and insights relevant this week. And starting off is just, man, if you remember the old Saturday Night Live skits, simmer down now. I mean, if you look at the headlines, everyone is absolutely freaking out about what's going on in the markets. And I get it, right? Let's rewind a little bit. Let's have some perspective before we have a panic attack. Right now, these headlines are reading stock market's worst day of 2025. By the way, we're on not even 90 full days into 2025, but worst day of the year is stoking bear market fears. And that's what everyone's freaked out about. Freaked out about tariffs, freaked out about a weak economy, freaked out about a recession, and freaked out because their 401k balances are going down. And you know, funny enough, there's a headline out there about we've seen the most trading in 401ks this week than we have in a typical month. So everyone is acting out of fear. That's something that's very clear when they shouldn't be doing that. And really, should we be following the fundamentals or our emotions? And this is what I want to bring it home with. This chart that I have on the screen for you to see shows you that the price action in the S&P 500 has not been driven down because earnings revisions have been made. It's not been driven down because some GDP growth number got revised down, which one did by the Atlanta Fed, but it was just an accounting snafu, the way that inventory is recorded. It's because sentiment changed. So right now, it's loud and clear, and we're going to spend another segment in here stepping through 10 different data points to prove to you that this is not the end of the world as we know it. It is not the end of your 401k as you know it. It is actually a great buying opportunity, which is really hard to do. I get that. So we're going to walk through that. But it's time to keep calm and keep buying. That's the headline number 1 that you got to go on. So back to the rundown. This is the thing we got to talk about. Recession? I think it was yesterday, if you looked at Bloomberg's home screen, they had the main ticker talking about recession fears and then 3 other headlines aside talking about recession fears. And now Yahoo Finance jumps into the mix today with the fact that the stock market's fate, the entire fate of the world in the stock market is now dependent on tariffs. Totally false. That's right. You're going to think that it's because of tariffs. You're going to think that's what the reality is. People needed an excuse. For months, investors have been complaining that the markets were overvalued, overcooked, and overhyped. Tariffs came along and serve as a disruption, a convenient scapegoat to blame and justify selling. Hey, we're worried about tariffs. But here's the irony. Tariffs really don't impact the markets that significantly. If you don't believe me, look at what happened last time when President Trump took office. He passed tariffs in 2018, and they stayed in place, every single last one of them, through the entire Biden administration. Did the economy have a huge hiccup? No, it did not because of tariffs. It was because of COVID and the Fed being late to the game. Did the stock markets crash? No, actually, they've been hitting a new all-time highs. So why is it going to be different this time? It's not. And so I've been a very big, loud, and outspoken proponent of the fact that we're not anywhere near a recession. In fact, I wrote an op-ed for Newsweek in the middle of last year claiming that, look, none of the economic data points point to a recession. And guess what? Fast forward to today, and there's really no concrete evidence that the economy is on the brink of a recession, which brings me to the most compelling data to prove that, right? If you look at mentions of tariffs and recessions by the CEOs and management teams of the top 500 companies in America, you know what they're talking about? Tariffs. You know what they're not talking about? Recession. In fact, 6 or 7 sectors, companies, there's not a single company in the consumer discretionary sector talking about a recession on this last quarter's conference calls. Now think about that. If corporate executives are not worried about a recession, should we be? No, because they're on the ground. They're in the trenches. They see it. So all these headlines about Trump's tariff tantrums are nothing more than that. They're just tantrums. They're noise. What we need to be worried about is when we start hearing a lot of executives talking about recessions. And as you see in this chart, those gray areas, we had that happen. There's a direct correlation between talk and economic changes. And we had that happen right around COVID. So that was when we had 2 quarters of negative GDP growth. I mean, falling off the cliff in 2020. The first quarter was down about 6 or 7%. And the second quarter of 2020, down a whopping 33% GDP before it violently rebounded. And then we had it again in 2022. We don't have that right now. So the mentions of recessions are not there. I encourage you to check out and always follow that as a key indicator of what's going to happen next. And here's what's most important. We are going to have a recession, another one. It's inevitable. It's not a matter of if, but how long it lasts. And I would argue with you that we're in the best position ever to have the shortest recession on record because we keep innovating. America is an innovation economy more so than anyone else. And if you look at the percentage of spending of revenue on research and development based upon GDP and the revenue of companies, it's not higher anywhere else than the United States. So well above the averages. And that, if we think about it, innovation, new ideas, turning them into patents, spending on research and development is building and planting the seeds for the future economic growth. And we have done that consistently, more so than any other country. You show it's reflected in GDP growth over the last decades. So again, take solace knowing no executives are afraid of an impending recession right now at the S&P 500 companies, but they're instead heads down, grinding away, innovating, and sowing the seeds of the next economic boom. So with that being said, I hope I've allayed some fears before I get to the fact that there's a lot of fear mongering out there. The last topic I want to cover in a rundown today is choose your friends wisely, as my parents always told me. Did I always do that? No. And I heard you learn the consequences the hard way. Who are your friends in the markets? If they are none other than the talking heads like Ray Dalio, I'm here to tell you, get some new friends. Ray Dalio has been perpetually predicting a doom and gloom boom cycle that we can't even keep track of all the headlines. I mean, we're showing some of them here. Dalio warns of a debt crisis, heart attack within 3 years. He thinks the Fed can repeat 1937 all over again. He thinks there's a 75-year debt supercycle that's about to implode and blow up the markets. Look, let me tell you this. There is a Ray Dalio every minute out there in the markets. There's always someone peddling fear. We just tend to listen to ones that are billionaires a little bit more, and I'm here to tell you, ignore them, right? Whether it's Peter Schiff, Ray Dalio, Jim Rickards, or the ilk that just scream from the rooftops that the end of America is coming, the end of the markets are coming. It's not true. I mean, let's just anchor ourselves in reality and look at the long-term performance of the markets, right? How many massive downturns, wealth-destroying depressions have we had? 1, 2, I mean, go back, 1926. You look here, these charts are unreadable, but they're here to just drive home a point. Don't worry about the labels, look at the lines. We don't have massive 50, 60, 70% drawdowns happening every 5 to 7 years. No, more than anything, it's a 10 to 15% drawdown. So this applies whether we're looking at from 1926 to 1958 to 1959 to 1991, even go through the dot-com boom and bust. The direction of the markets is consistently up and to the right. So all that to say, don't give in to the fright in the headlines from the likes of Ray Dalio. They're like a broken clock. They're right twice, maybe. And when they are, and they do seem right in a moment, they lean in and get louder and louder. And the only impact of that is usually to scare everyone stockless when that's exactly the wrong thing to do. It wasn't the right thing to do when everyone was afraid of COVID. It wasn't the right thing to do during the financial crisis. And it wasn't the right thing to do going further back during the real estate crisis. So it's not the right thing to do now. I know I'm saying this in a day when the markets continue to sell off, but I'm telling you, history is on our side. And hopefully, your portfolio balances will be on our side as we look out 3, 6, 9 months from now. If not, chime in, speak up, and give me hell for being dead wrong 6 months from now, because I will gladly take it. But I'm putting probabilities in the numbers and the markets on my side that they are up and to the right. So again, permanently ignore the perma bears. It's the best thing you can do. Delete people that are just toxic in your life, and that includes people in the investment world like these guys. I do it, and it makes my life a lot better and keeps me sleeping well at night. So with that being said, we're going to take a word and a pause to get a word from our sponsors. But before we do that, I want to make sure that you're signed up to receive the Big Skinny newsletter, because we're not just a live streaming show. We do this 3 times a week in your inbox, where we give you one headline, one chart, one investment insight. So if you're not signed up yet, please go ahead, whip out your phone and scan that QR code. It'll get you signed up in a snap so that you can have the market-breaking insights in your inbox whenever you want them. Data-driven always, right? I'm a contrarian by nature, but it's always because of the data, not just because it's cool to be a contrarian. So with that being said, we're going to take a pause for a word from our sponsors, and then we'll be right back. This is going to be an ad normally. I don't know. I'm struggling, guys. Where's the ad language? Here it is. This shows that we're live because I'm prone to make mistakes here, but yeah, that's right. I know. Screw up number 1 for Mr. Basenese. Looking for top quality, fully custom golf polos and lightweight quarter zips? Well, that's what Butcher Golf is all about. Fully custom, really fast. And I'm going to be really in trouble with this sponsor because I didn't start this out of the gate well. But thankfully, it's my friend, member that you'll meet here. So if you want fully custom polos and quarter zips in as small quantities as 25 and as large quantities as 2,500, you can go check out butchergolf.com. If you mentioned you know Sweet Lou, you get a 20% discount. So again, Butcher Golf, fully custom, really fast. Visit butchergolf.com today. We'll be right back. All right, we're back to the Big Skinny with Lou Basenese, and no more screw-ups this time around, Lou. I need the pep talk. Well, the guy that's coming to join us now is a good friend that never messes up. He is impeccable, an incredible presenter, and more than anything, he's an incredible investor. And I can say that confidently after working alongside him and being in the markets with him for now going on our third decade. So it is with great pleasure and honor I get to welcome Keith Fitz-Gerald, the principal of the Fitz-Gerald Group. Welcome to the show, my friend.
Thank you so much for having me. What a grand adventure this is going to be, huh?
Yeah, it is. We have no idea where it's going, but as you know, as a motorcycle enthusiast, sometimes the journey is just in the decision of picking and turning and going in a direction.
Absolutely. Go where the front tire takes you.
That's right. I like that one. I'm gonna steal that, my friend.
Okay.
Don't use it on Varney next week. I got it first. So let me ask you, viewers here always want to know, they want to get to the goods, right? What are your stock picks? What do you like? What are we buying? What are we selling? I got to honestly just confess, Palantir, missed it mightily. Too late to buy? What's your latest thoughts on Palantir, and what exactly do they do?
Well, the answers are complex but simple. No, you're not too late. Yes, it's still a great value. And what do? They make software that works. The thing that's so unique about this company at this particular point in time is that you've got stacks of silos from legacy software providers, none of which can talk to each other, none of which have actionable information flowing back and forth. What Palantir has done is come in and built a model that nests on top of all those and sits between the difference of all of that information and putting together analysis and ways and questions and answers and actionable bits that we've never been able to do before, never been able to see before.
So is it doing that with unstructured data as well, or is it all how is it working across any platform? It's agnostic where the data is coming from?
It's agnostic, and what makes it so valuable to the customers, right, is that they can come in, the Palantir engineers sit down and say, what do you want to accomplish? What are you trying to answer? Where do we get to this? And they develop a client-specific model to answer client-specific questions. That makes it very sticky and very, very valuable.
Yeah. So talk to me, how has this opportunity evolved with AI, right? Because again, I want you to brag. What was your original entry price where you started buying shares and telling people to buy shares?
My goodness.
I'm going to get pissed because I wasn't one of them, but go ahead. Go ahead.
Well, as many people watching might know, I started talking about this on national television at about $7 a share.
Yeah.
So
it could have been I wish I was a little bit taller. I wish I was a little bit richer because of Palantir. How's it evolved with AI over that time, right? Because at $7 a share, it probably wasn't a big hype-driven trend in AI yet. That we're still in the early stages, nascent stages of that. What's changed for Palantir over that time?
Well, we're still in the nascent stages of that, right? Because we don't know what questions to ask, but we know the answers we're starting to receive are very, very valuable. So for example, they've got their 6th annual AIP convention going on right now. And what that's doing, you've got clients volunteering on an unpaid basis to show up and tell the world what they're doing with Palantir products. Are they selling more? Are they building efficiency? Have they increased the return on investment? One insurance company, for example, took an underwriting process that was formerly 3 weeks and got it down to 2 hours using Palantir systems.
That's amazing.
Think about the profitability that goes with that. They can sell more, they can do more, they can make more immediate decisions. It's going to change credit rating. It's going to change our military. It's going to change our government. It's going to change efficiency. This is a win-win-win. As much as I hate that term, it really is all the way across the board for anybody who gets within its orbit.
Well, and you said something I want to pull that thread a little bit about where you're doing things faster, more efficient, right? You go from 3 months to 2 hours. I've talked about companies in the drug discovery space or the protein construction space where they're doing things that used to take months in a matter of hours as well. I argue that really is the benefit of AI. AI is not a product. It's a supercharger to do things that other people do well already and make them do it much faster. Do you see it the same way, or do you see that AI, there's a silver bullet solution out there that's a product, that's a killer product?
No, I agree with you, but I would take it one step further because right now we're in sort of iterative or generative AI, right? We have to have information put in, then it takes it, it uses it, manipulates it, and puts it out. But it is not going to be all that far away. My guess is maybe 5 years from now, we're going to see inferential AI, meaning that it's going to begin to think for itself with a very high degree of accuracy. And when that happens, we're not only going to leapfrog drug development, but we're going to solve many of the problems we're dealing with today. I think we're going to solve a lot of the political angst that's with us today. We're going to solve money. We're going to solve cancer. We're going to solve hunger, water. Many of the things that are plaguing humanity today, I think, are going to become opportunities and solutions for those companies that really embrace this. But to me, it's not just a technology like a lot of investors think. It is the technology. It is something that is going to change the course of human history. And I made that remark on CNBC a while back, as this is perhaps the greatest single investing opportunity in recorded human history. And based on what we're seeing, I might not be off base, Lou.
No, listen, I completely agree with you. I mean, it sounded ridiculous. I said this probably, I don't know, 6 months or 9 months ago on air, that there will come a day because of AI and drug discovery where getting cancer will be as solvable as getting a headache and taking a few pills, because we will understand how the body's own immune system works and combats, and we'll figure out how to activate it very quickly, efficiently, and more than anything, safely. So I'm on board with you 100%. So that just brings us naturally to another topic that I think you and I always have been in agreement on. Not afraid to be contrarian on Apple, right? AI and Apple. Everyone's worried that it's Apple's rotting from the core because they haven't focused on AI. Agree or disagree? How do you see Apple?
Oh, I disagree entirely. I think the company is far more along on AI than many people realize. If we look at Apple's history, they are most dangerous and potentially most profitable when they're quietest. So the recent decision to pull back Siri because they don't have a model ready tells me that they're not ready to unleash the transformative Apple trademark experience. So if you look at the iPhone, it wasn't new to have a smartphone, but the way they unleashed it changed consumer behavior forever. AI, I think they want to do the exact same thing. Wearables, same thing. Earbuds, same thing. Services are $100+ billion a year. 1 in 4 people on the planet is accessing some form of AI or big data already through an Apple device. Right. So this is just a question of what are we going to do and when, not are they behind.
No, I agree. And we brought this up last week. We talked about just that services business on a standalone basis is almost as big as Tesla and Disney on its own, right? The entire companies, and bigger than Nike. So,
well, to your people forget, Lou, they remember back to 2014 when they launched that, right? And you and I first started talking about it. How many times did we hear from conventional Wall Street, oh, this is going to distract them from iPhones. This is a terrible decision. They shouldn't do it. I'm like, you and I looked at each other and said, I want to bet.
Listen, I remember the best, and I feel bad because it's elder abuse at this point. I can't remember his name, but he was probably the oldest gray-haired guy on the CNBC at the time. Said I was brain dead if I thought that Apple was a no-brainer buy, and that was 2014 at like $40 split adjusted. So, man, I'll be happily brain dead if we get more opportunities like that. Yeah, I mean, the services business alone is a juggernaut, and AI just becomes an accelerant, a force multiplier in there. So happy higher days ahead for Apple, I think, and you and I can celebrate that one together. Before I let you go, I do want to ask you, just sentiment in the market, right? We're seeing, consecutive days of sell-offs. Everyone's freaking out. We're at or in a correction territory, depending on what index you're looking at, what other asset. How do you see this from sentiment, and how do you play it?
Well, having been doing this for a long time, 45 years at this point, one of the lessons I've learned the hard way is that the herd is almost always wrong. And when you get everybody lined up on one side of the boat saying, oh, this is terrible, it's the end of the financial universe as we know it, history shows very definitively that's not the case.
So there's no wisdom in crowds, Keith. Come on, there's got to be wisdom.
Madness in crowds, perhaps, but not wisdom in crowds. We're approaching levels now where sentiment is so universally negative. And we know from data that 85+% of all retail investing decisions are wrong, meaning people are buying when they should be selling and selling when they should be buying. I have a very high degree of confidence that I'm going to invest for the future, not where we've been. So I'm actively looking to buy in these, in these areas, and I have been.
Yeah. Is there anything in particular you've been scooping up? I'm going to share 2 later in the show with people, so I won't steal that thunder. But anything this week that you were like, hey, I've got to buy more of that. I got to own it at these levels.
Well, both of the names we just talked about. I'm very comfortable with where we're going to be in 10 years with these things. So, that's my time horizon. I think that the reason many investors fail, Lou, is because they don't have a long-term framework in place to get them through the short-term noise. So when they hit the short-term noise, they get emotional, they get disconnected, and they start making stupid decisions.
Yeah, and everyone knows my wife will tell you I don't make good decisions when I'm emotional or hungry either as an Italian. So
there you go.
Listen, you had a very compelling stat in there, right? And I don't doubt the source that 85% of investors fail because they'd make the wrong moves at the wrong time. They're going with the crowd, the herd mentality. They don't do that if they're following you. So I want to give last word to you for you to share. How do viewers today work with you, benefit from your insights? Obviously, you're on CNBC, Fox Business, and every other channel all the time, but in a more direct way. How do they communicate with you and benefit from your wisdom?
No, you're very kind. The easiest thing to do is just read the 5 with Fitz, which are my personal trading and investing notes that I've written for decades. And somebody told me I should publish them during COVID. I thought nobody'd come to the party, but in fact, tens of thousands have come to the party. So it's irreverent, it's unfiltered, but it's what I'm thinking about every single day. And if that's helpful, I'd love to have them at the party.
Listen, everyone, you need to go sign up for the 5 with Fitz, because here's what I love about Keith. Not only is he just got an incredible track record, he's a great family man, has a beautiful wife and 2 sons that are more accomplished than I could ever be in my life. He is a faithful father. But he loves to have fun and irreverent. What are we doing this for if we're not having fun? And he's got quips that I can't even keep up with sometimes. So if nothing else, you'll be entertained, but I can guarantee you your bottom line will be enriched as well. Keith, always a pleasure. Next time you're in New York, we got to get together. And thank you again for joining the show.
An absolute pleasure and honor. Thanks to everyone for spending a few minutes with me today. Thanks, Lou.
All right, folks, we're coming up again on a commercial break. But before we do, I want to make sure you're signed up for the Big Skinny at thebigskinny.com. You can do that by scanning the QR code on the screen. Remember, as Keith has a simple formula of 5 with Fitz, 5 things he's looking at, we have a simple formula for our newsletter as well. It's one headline that you should ignore or really pay attention to, one chart that has the data that is the most key data that you need to understand, and one investment insight, including individual stock recommendations that tend to be tech related. So please do not hesitate to chime in. We've got time for comments coming up in the D block. We can answer them live through the show in the next block as well. So with that being said, let's pause again for a word from our sponsor. Today's episode of The Big Skinny is proudly sponsored by, oops, we forgot to get a second sponsor, Inc., your one-stop shop for awkward silence and unpaid ads. But hey, don't be like us. Get your brand in front of millions, all right, thousands, thanks to Keith's participation, of tech-savvy, stock-watching, snack-munching fans who tune in just to hear us talk about stuff we Googled 5 minutes before the show. So don't miss out. Email info@thebigskinny.com. That's info@thebigskinny.com today, and make this awkward silence a distant memory. Trust us, your brand deserves better than this. We'll be right back. All right, we're back. The Big Skinny with Lou Basenese. In this section, I want to cover 10 of the things that are most important right now so that you can settle down, relax, have some perspective on all the selling that's happened in the last week or so since Monday, and then really feel confident as we go into the Q&A where we're going to share two things that I'm actually been buying. So again, you can't just go and say, hey, go buy this when you're not comfortable doing that. So let's go. And if you haven't signed up for our newsletter, I go into more detail providing the charts because some people learn visually behind this. Sign up with the QR code here. Go to our website. You'll see this post that has been made on the top 10 reasons with actual data to back it up and the visuals. But I want to run down them because it's overwhelming that we've hit extreme levels. So first and foremost, if you look at put option volumes, right? These are contracts that are essentially betting against the stock market, betting against individual stocks. We just hit an all-time high. When's the last time that you know that everyone was betting in one direction and was right? Yeah, it doesn't happen. Even if you a long time ago were betting on the Yankees to win every World Series, right? It just doesn't happen. When everyone thinks alike, everyone is likely wrong. So with that many people betting against the market falling precipitously even more from here, it's unlikely that they're right. Another anchor point that we can just put in there in terms of sentiment is looking at the VIX, right? The VIX volatility index is known as the fear gauge in the market. And when it spikes, it means everyone's getting afraid. Well, it did spike this week. It spiked to north of 27. Right? So the key level there typically and traditionally has been 30. When we get to big panics in the market, ahead of sell-offs, you see the VIX spike above 30. But one spike alone is not reason to run for the hills. In fact, here's the key thing you need to know. If the VIX spikes over 27.3 11 or more times in the year, then if you look back historically, the markets tend to finish down for that year. So what's the counter at for this year? Uno. That's it. No más. That's one time. So I think we're safe from the VIX standpoint from spiking up before we have to worry about negative returns from the year. What about if we just look at fiscal uncertainty, right? We don't have a government that can ever figure out how to keep itself funded without having chaos and the threats of shutdowns. This fiscal uncertainty can be measured in terms of fundamental uncertainty if you look at the spreads and the ratio between investment grade bonds. I won't geek out and get into this with you except to say this. When you look at the ratio getting to extremes, traditionally, this has been a harbinger of positive returns moving forward for equities. So the VIX is not working against us. And if we look at this here in terms of fiscal uncertainty, it's not a reason alone for us to be selling stocks. Well, what about selling volumes? Speaking of this, well, if you looked in the NASDAQ, we're coming off the fourth most trading volume day in NASDAQ history. Guess what happened after the last three big volume days? The markets were up 6 months from then. So everyone tends to panic, sell first, ask questions later. That's exactly what happened yesterday and this week. We're seeing it again. These are the signs of a bottom, not the signs of an imminent leg further down. Speaking of legs down, drawdowns are normal for the S&P 500. They're absolutely normal. On average, we have 1% drawdowns, 2% drawdowns, 3% drawdowns, and every so often we have these 10% and plus drawdowns. They are part of trading in the markets. Almost every year in the market, you're going to see a 5 to 10% drawdown. What about for the NASDAQ, you say? Well, that's drawdowns part two. They happen. Shit happens in the markets. Things sell off in the markets. It doesn't matter whether it's the overweighted tech-heavy NASDAQ index or the 500 largest companies in the S&P 500. Volatility is the norm. We should expect some of it. We shouldn't be worried about it happening. Instead, we should be prepared and plan on it happening. What do you do with that? What do I mean by that? Have some cash ready. If you know something that you love is going to be on sale eventually throughout the year, don't you want to keep some money aside to buy more of it? I mean, doesn't Amazon do a sale, their Cyber Monday sale every year, and we're all thinking about that and waiting for those times to buy? It's no different in the stock market, except the products are actual investments in businesses. So those are the top 10 things to watch. Those are the first 5, went through the 6s. Again, drawdowns happen. We also have to think about corrections that happen. They correct behavior. Again, I mentioned earlier in the show, what was everyone complaining about going back, 6, 7, 8 months? Valuations. The market was too rich. The Mag 7 plus Netflix were too rich. They were trading too high. I think they peaked at about 38 times earnings. Now where are they trading at? About 22, right? So after a correction, everything gets level set and reset. If you look at large caps, the S&P 500 started trading at 23 times earnings, now down to a multiple of 20 times. Small and mid caps are down from 16, 17 down to 14, 15. If you go to international and emerging markets, you can get even more bargains. So the benefit of prices coming down without earnings growth slowing down is that things go on sale, and that's exactly what's happened. So people become more disciplined investors. If you like something at 38 times earnings, you should absolutely love it at 20. It's counterintuitive to see price plummet and then you get more aggressive and greedy, but that's exactly what we're supposed to do. Here's why. After the declines, we know what comes next. It's gains. So if you look at the past 50 plus years of corrections in the S&P 500, every single time the S&P 500 has come down 10%, 3 months later, 6 months later, 12 months later, the stock market's been higher. So again, why be the one that panics and sells, that sits on the sidelines and misses out on the gains? You actually just compound your losses at that point, because not always you're going to get good returns in cash. We're lucky right now. It's been since 2003 to 2005 before we had similar returns for cash on cash of 4 to 5%. You sit out of the market and the market rips 20% again, 30% again, because you panic sold, you're compounding those decisions. So ride out the volatility. Here's the things that really make me pay attention to is sentiment readings, right? Keith mentioned it. We talked about it in our interview with him. My best leading indicator has been the American Association of Individual Investors Bullish Sentiment Index. It just cratered to 18.3 or 18.4. Did you know in the history of this index, every time that this index drops below 20, I think it's happened 35 to 37 times, and actually it's not every time anymore, it was every time, but 98% of the time the markets are higher 3, 6, 9, and 12 months later. When everyone freaks out, I mean, it's the old Warren Buffett adage to be fearful when others are greedy and greedy when others are fearful. The AAII index is the perfect way to track this. It just hit a level that is a screaming buy signal. I get accused of being always focused on the upside and a little too optimistic. So here's the last thing in this rundown of Simmer Down Now that I want to cover for you. What's the worst case scenario, right? What's the worst thing that could happen in the markets? This 10% correction turns into a little bit worse. Well, if we don't have a recession, we maybe not have another 15% down, right? It's a 21% on average downturn for the markets, right? We can weather 20-ish% downturns, especially if what follows that is 30, 40, 50% gains. By the way, that's what we saw, 2 years of 20+% gains in the S&P 500. So again, no whammies. We don't want any whammies. We don't want a recession. We talked about that earlier. I'm going to be covering that in more depth in this weekend's edition of The Big Skinny. But at the end of the day, here's what you need to keep in mind. Keep calm, carry on, and get ready to start buying when the market sells off. Don't overinvest. Don't overuse leverage. That's not the way to win in this market. Please hear me clearly. I'm not saying if you don't have any cash available to go on margin right now. That could just make things worse and more painful. Another rule of thumb, if you're up worried about a single individual investment at night, if it's keeping you up at night, you own a little too much. So if you've got a big holding in Apple, Palantir, because you're sitting on huge gains, take some of those off the table, a little bit portion, and start looking to put them back to work in this market. And after we come back from this latest break, we're going to talk about 2 ideas that I actually did put some money to work in this week. So with that being said, let's have a word from our sponsor, and then we'll get back to the Q&A with you. So tee up those questions, tee up the Pat Benatar, hit us with your best shot right after this word. Again, this is where your ad could go. Today's episode of The Big Skinny is brought to you by Wow, This Spot Feels Empty, LLC, the world's leading provider of missed advertising opportunities. But don't worry, you can fix that. Imagine your brand right here reaching millions. Okay, thousands of highly intelligent, definitely influential listeners hanging on our every investment insight and tech take. Your sponsorship could help us keep the lights on, send our kids to college, and hopefully afford our sushi habit. So don't let this golden opportunity slip away. Email info@thebigskinny and claim this space before we have to start selling plasma to fund the next episode. We'll be right back. All right, welcome back. We're in the Dodd block where my partner, friend, and designer extraordinaire that has come up with all these graphics. Man, I love them. They get better every time. The Trump crybaby tariff tantrum one. Bravo. If we had awards here, we'd give it to you for that. Well done, my friend. Good to have you back. Well, hey, this is the time of the show where I crack a beer and we crack some questions. So we got some coming in from the live stream, but I know you always have it too. This is what I love about Dodd. He's always been a value add in my life because he makes sure that I stay on track and make sure I explain things, clarify them, because yeah, when you do one thing all the time, you can easily speak in language that no one else understands. So what mess up? Yeah, what did I say wrong this time? What was not clear? How can I help and clarify?
I don't think you messed anything up today, Lou. Actually, I wanted to start off by saying you impressed me today, like more than ever. Like you went to a whole new level. And it started.
I got to take a sip for this.
It started about 2 hours before the show, actually. You know, we, like you said last week, we've worked together for like 20 years, and I've always known you to kind of do things at the last second, you know, before you go on stage or editing video or putting some new graphics in a presentation. That's all normal, which stresses me out, but you know, you just roll. And today, you know, I'm sitting watching you on Varney and Company, sitting between Stuart and Lauren, and right in the middle of the segment, I'm getting texts about today's show going, hey, can we move this here? Rumor. Should we do this? Can we do this? You know, so I just have to know, you know, live on set, you're helping today's show. Are you just an extreme multitasker or a habitual procrastinator?
I can either confirm or deny either of those two labels. I like to an alternate one. I am just-in-time manufacturing for ideas. Right? It happens right on the spot. So, yeah, just in time. Yeah, listen. You know, sometimes you're in the spotlight, sometimes you're not. So I had some burning questions I needed you to answer. So thanks for calling me out, brother.
Hey, anytime, man. That's what I'm here for.
I think we have some questions from our viewers. Let's get to those now. So from Jennifer Di Pasquale, a good Italian last name. How do you know what is an appropriate sale price for a given stock? It's a great question, and I'm not going to give you a great answer that you're going to like probably, because everyone wants to know that, hey, you sell at this amount or when it hits this level. I follow a straightforward rule because you always want to let your winners run. You never know where they're going to stop, right? So I advocate two things. If it's a small cap or micro cap stock and you've doubled your money, take half of it off the table. You're immediately getting your principal back. It's a rule of thumb. Yep, it means you miss out on the next 2, 3, 4, 5x on all that position, but it also makes sure that if the stock goes back down, you don't round trip it, which happened to a lot of people in the .com days. So rule number one, and Dodd can attest to this because we've walked through investments
together.
With
the house's money.
Play with the house's money as often as you can. So that means up 100% or almost 100%, sell half, you get your investment back, and then you can deploy that somewhere else. The other thing I advocate doing is using in larger cap, mid cap names, a trailing stop. And this is essentially an order that you put in with your brokerage that adjusts as the stock price keeps going up. So you can put it at a level, usually I advocate for 20 to 25% below the closing high. So each time a stock hits a new closing high, that trailing stop comes up and adjust so that you keep selling it. If it drops down, you'd sell at a higher and higher price. Because again, we want to let our winners run. We don't want to sell them prematurely, but at the same time, we don't want to get overweighted. Like I said earlier, if you're up at night because you own way too much Apple because it's gone up too much, you need to sell some. But hopefully that helps. Another question from you. Great. How do you sign up for the newsletter? I think we put up on the screen the QR code multiple times, or you can go to thebigskinny.com. It's easy to sign up. We will not share your information with anyone else. We don't have any annoying 16-page sales letters either. We just serve up straightforward investing insights and interesting investment ideas from time to time as well. So if you're interested, go to thebigskinny.com and click on subscribe or scan the QR code on your screen. All right, Dodd, what else you got for me?
Well, Lou, you know, you keep banging the drum about this, not entering a bear market and, kind of back the truck up because it soon will be time to, really start buying stocks. For an average guy like me that, has a portfolio, it's obviously it's been down like all of ours, but, I don't have a lot of, liquid cash sitting around. You alluded to it a little bit before about, maybe it's not time to sell the 401k and, dip into savings, but, how convicted are you and, how much, buying should we be doing in a position like the average guy like myself?
Yeah, so I can't give you individual investment advice. Here's what I can tell you, though. How I do things, right? So I have 60 to 70% of my money traditionally in low-cost ETFs and mutual funds where you're asset allocated and diversified. The other, call it 30 to 40%, because I am a stock guy. So for you, it could be 20 to 30%, should be in individual stocks that you're going to make more money in. So in that portfolio, and if it's in a 401k, you have the tax advantage there too, where you make money, you can sell it without having to worry about paying taxes. So I think now is absolutely a time. I mean, if you were buying stocks 6 months ago, why wouldn't you be buying them today? So I think that means you need to be selling something if you don't have any cash. So sell, if it's in a 401k, do not cause any tax liabilities. Sell something that's up a little to free up some capital to buy something that's very cheap. This in the financial world is called portfolio rebalancing, reallocation. I think it makes perfect sense in this market right now. If you had a lot of the S&P 500, we're getting more into a stock pickers market or big tech. We talked about it last week. European stocks are really cheap. There's a couple ETFs that focus just on Europe or all international. Those would be compelling buys right now to put new money to work in, where you don't have to worry about picking a single stock. I shared on air today with Varney, and after our interview with Tom Hayes last week, I started buying Alibaba. I think it's a cheap, quick-growing AI play that you can get exposure in China at 14 times earnings instead of paying, I think, NVIDIA right now is trading at like 25, 26 times earnings. So those are some of those recommendations along the way.
All right. Well, I was going to follow that up with, and what stocks are you specifically buying? I know Alibaba, this week, are there any others that you're buying right now? Personally?
Yeah, there's one other company that I bought this week. It's called Core Scientific. CORZ is the ticker. I think this is the smartest way to play AI and crypto in a single stock. And there's going to be a story here that's going to emerge. So Core Scientific used to be a Bitcoin miner. They were smart. They have a lot of data centers. They secured power agreements, which if you read anything or listen to anything in the news now, that's the key gating item, growth issue with scaling AI is we need the power. They secured that, and instead of mining Bitcoin 100% now, they've started slowly leasing out that data center space to hyperscalers. And one in particular, CoreWeave, just signed a massive deal with OpenAI and indirectly through Microsoft. So they're going to go public soon, CoreWeave. Hot IPOs are never that hot. As individual investors, we always get screwed. So instead of playing the CoreWeave IPO, I think that Core Scientific is a backdoor way to play CoreWeave. It's traded down to about $8 to $9. I think this is really compelling. The last time, about 4 or 5 months ago, it went up almost double that. I think this is an easy double in a tough tape if you're willing to hold for 6 to 9 months. So CORZ, I don't know if we can pull up a ticker on that sometime, but go to your screen, whatever your favorite financial site is, and pull it up, and you'll see the run up and look at the news developments. It's a very significant player in the AI space with the key ingredients that you need to win, and that's energy and data centers that are already built out.
Sounds good. CORZ. I'll have to look at that.
Are you buying it right now?
Not right now. I can't multitask like you multitask, so I'm going to just do one thing at a time.
Yeah. So you see here the chart. I mean, again, it got up north of 16, so double from current prices essentially right now. I think that's the opportunity here. It's a multi-billion-dollar company, so you're not buying a penny stock under $10. I love investments that are under $10. They're much more manageable. But yeah, that's another ticker that I bought earlier this week, yesterday, in fact. So. With that being said, I know we had a couple comments, people thanking us for bringing Keith on, thanking him for his insights. So I want to thank you, everyone, for listening. If you do have any other questions, comments, if you can refer us to other people, please do. If you enjoyed the show, if we entertained you or we gave you good investment ideas, pass it along. That's the purpose of what we're doing here. And again, we ask you to just, if you haven't signed up already, sign up for our newsletter at thebigskinny.com. You can scan the QR code on your screen, and we'll be in your inbox 3 times a week with one headline that you really need to pay attention to that most likely is misleading you. One chart that's going to give you the data that leads you to one investment insight that will hopefully increase your bottom line. So, Todd, thank you as always. Thank you, Thanks, everyone, for listening. We'll be back here next Thursday, 2 p.m. Eastern, sharp. That's it. Lou Basenese signing off with The Big Skinny.